In this week's video, we'll use the charts and the hard evidence to examine the question, is the stage set for a year-end rally in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick it off with the most important chart on Wall Street. Did we hold 10,301 on the weekly NYSE composite? We have. We closed Friday, October 31st at 10,844 and change. As long as we stay above these lines, all things being equal, it's bullish. As we've said many times, there's no perfect chart or indicator or method. There's numerous things that can help us from a probabilistic perspective. Looking at the same NYSE chart, this time on a monthly, this is what's known as a hammer candlestick, and from a probability perspective, it tends to be bullish. You get a little bit of a hammer look here, good things happen. A little bit of a hammer look here, good things happened. A little bit of a hammer look here, good things happened. This tells us exactly what happened. We had weakness and we rebounded. It's probably more important that it happened near potential support. It somewhat confirms this area here. The longer we stay above it on a monthly chart, the better for the stock market bulls. If we break below it, it reverts back to a failed breakout, and it's a yellow flag. Regular viewers know this chart. They know that we use momentum. When momentum falls out of overbought territory, as it did here, this is observable. After that, bad things happened. Speaks to probabilities. We were in oversold territory, and we recaptured overbought territory. As long as we stay in overbought territory, like this period here, the probability of good things happening is higher. You can see oversold moves back to overbought. Good things happen for some time on the weekly chart. Oversold moves back to overbought. The probability of good things happening increases. As long as this stays above -20, it checks bullish boxes in the CCM market model. Everything that we just said about the weekly chart of the S&P 500 applies to the NASDAQ or tech stocks. We were in oversold territory. We closed in overbought territory. Updating the weekly chart of small caps, the IWM ETF, you can see during the recent pullback, we broke support. On the V bottom, we rebounded and recaptured it. We've also broken this trend line, so several good things have happened from a bullish perspective. Recaptured this line, this line, this line, broke this downward sloping trend line, went from a full bore bearish look to a full bore bullish look. All of it speaks to probabilities of good things happening. This is a higher probability look here than it was here, and then bad things did happen. We're focusing on the fundamentals, blocking and tackling for the remainder of the video, and we'll move quickly. We'll explain this once. If you're new to the fold, this is the S&P 500 weekly. This is price here. The blue and the red lines are moving averages that help us discern trends. This is what a downtrend looks like. We refer to this as a full bore bearish look. Price is below both moving averages. Blue is below red, and the slopes of both are down, telling us that the probability of bad things happening is higher here than it was here. Conversely, this is a full bore bullish look from a probabilistic perspective. Price is above both moving averages. Blue is above red, and the slopes of both are up. You can see here we went to a low probability scenario where we reduced our exposure to equities. We've slowly morphed back into a full bore bullish look. Typically, when you get something like this, you rally for several weeks or several months. And that's why we've scaled back in. It has nothing to do with these highs here. It's to try to capture what could be a multiple week or multiple month rally. We don't know what's going to happen. We speak in probabilities here. Anything can happen. And we'll go into next week with a flexible and open mind. You can see the S&P 500 from a bullish perspective made a new weekly closing high this week, which is also a good sign. The market model diversifies its inputs and uses many risk-on versus risk-off ratios. This is being long the S&P 500 relative to being short. This is what it looked like in 2008, low probability. This is what it looked like early in 2009, a higher probability scenario. We use these extreme examples for illustrative purposes only. We aren't necessarily saying that 2014 is similar to either one of these periods. We're just talking about probabilities and basic concepts. Like the previous chart, this has gone from a low probability look where we don't want to put our capital at risk, or we want to reduce our risk level, back to a full bore bullish look, and also made a new weekly closing high. How long will it look like this? We don't know. As long as it does, it will check bullish boxes in the CCM market model. Typically, when you move into a bear market, that's a deflationary event. And when we have falling prices, stuffing money under your mattress or bonds are attractive, and thus monitoring risk-on stocks relative to risk-off bonds can be helpful. It's not perfect. It's just one of the inputs that the model uses. Similar concepts, low probability look recently has flipped back to a higher probability look as of the close on Friday, October 31st. Same concepts looking at tech stocks. We want to reduce our exposure to stocks as the odds deteriorate and increase our exposure when the odds become more favorable. NASDAQ also made a new weekly closing high and has flipped back to a full bore bullish look. Just as it wasn't particularly useful to forecast a new bear market or multiple month decline here, it's not productive to do it in this direction either. We just need to take it day by day. This showed it. When we take it day by day, we can keep an open mind, allowing us to scale back in when the odds improve. This is the Dow in 1987. Probability of bad things happening increased before bad things happened. 1998, the probability of good things happening was more favorable here than it was here, and after that, indeed, good things happened. The Dow in 2014 made a new weekly closing high and has moved back to a full-bore bullish look. As always, we will enter next week with a flexible and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.